All right, I think our next guest is Marco, and Marco runs the Northstar Managed Fund or Balanced Fund, and as well as our South African Equity Fund, and probably one of the toughest jobs at Northstar, considering the state of the South African market over the last 5 years. And just to contextualize, the South African market's been one of the best performing markets in the world over 20 years. And it's actually been one of the worst performing markets in the world over 5 years. And I'm sure a lot of the clients know that. And we'll see in our quarterly report, it's an article I've just written, if you exclude NASPAS and the commodities out of the JSE over the last 5 years, the market's down, the average stock's down 24%. Yet, including those two areas of the market's up 14% on a cumulative basis. So really a hard time to be a South African manager. And fortunately, we've held a lot of NASPAS. We haven't necessarily held a lot of commodities, being a quality manager ourselves, but we've more than made up for that by owning a lot of offshore stocks for clients. So, Marco really does sit in the hot seat, and to some extent me as well. But I think we've done really well in the funds. And, if I look mainly at the managed fund, which has been going now for a longer period of time, and we've got a history of managing a managed fund for 20 years. I mean, it's one of the longest track records in South Africa. I think we understand the product really, really well. And a managed fund really has two elements to it. It's an asset allocation decision that the managers have to make. And we are lucky enough to have strong competency offshore, strong income competency at Northstar, and a strong local equity competency. So we managed to navigate that asset allocation call in a very constructive way and been good at it. We can see we add value. And then, of course, we also have to pick the stocks, which is the tough part in the South African market when most things have been going backwards. But Marco, just if we focus for a second on the managed fund, what did we do right leading up to COVID? What do you think we could have done wrong or better?
Yeah, so as you said, the managed fund is, it uses all the skill set that we have. It's a collaboration of a lot of elements. So there's an offshore component, there's an income component, there's a local equity component that all come together. So the fund has done really well over the last 3 years. We always want to generate higher absolute returns for clients, but in terms of peers, it's generally gone in the top quartile against peers in the same category. So we're quite happy in terms of performance. So what's worked is, it's a couple of decisions. The first one is that we decided to have maximum offshore exposure, and offshore assets have delivered better returns than our local assets, both fixed income and equity. The second call is the fact that our stock picking has generally been good, particularly on the offshore side. We've been able to express our philosophy more purely. The local equity side is obviously, as you said, been a much more difficult space, and the right decision in the managed fund was to de-risk the fund and have a lower percentage of local equity stocks in the fund.
All right, so just pinpointing that decision. So when we decide that we're going to have higher or lower weightings in equities, and let's look at the local side. And that fund kind of tends to operate between 35 and 50% domestic equities. And it's just if we look at a band, how do we know when we've got to be at 35%, and how do we know when we've got to be at 50%? What drives that decision in domestic equities? Just briefly to give our viewers some understanding of what process we go through to determine that weighting.
Yeah, so there's two main inputs into that decision. I think the most important one is our buy list, our expected return framework, or how much return we expect to generate based on our own work on stocks. So if the returns are obviously lower than other asset classes, on a risk-adjusted basis, we'll tend to de-risk or be closer to 35%. And vice versa, if expected returns are very high, we'll up-risk the fund. The other component is a bit of a top-down or macro view, where we look at what is a normalized level of profitability or returns in the equity space. And based on those two inputs, we make a call of where we want to be. Are there better opportunity sets in the fixed income space or offshore space?
All right, so the bottom-up stock selection side, we've got an intrinsic value for our buy list. We track that daily. So it gives us an idea of what intrinsic value upside effectively is in the portfolio at any moment in time. So if we have to just give viewers some insight into that, every day we have a group of stocks that sit on our buy list. We know what they're worth. We can calculate if on a daily basis, if they went to what we think they're worth, what kind of potential returns they could generate in the portfolio. And if that return is higher than the average, we would upweight our equities. And if it's lower than average, we would downweight our equities. That's effectively what you're saying from stock selection perspective. And Marco, one of the kind of pointers I've noted is that we've almost consistently been underweight South African equities for a few years versus our competitors, because we track our competitors. So that framework has been working. Do you think our normalization of profits and that when we do our valuation work has led us just to be more conservative?
Yeah, I certainly think so. I think the forecasting risk in evaluating South African companies has certainly changed. And we have to acknowledge that. So as much as we can come up with a valuation on a stock, on a portfolio of stocks, the risk of us being wrong is a lot higher now than what it used to be back in the past. And if you acknowledge it from a portfolio construction point of view, you'll come up with generally a lower weighting in the fund.
So to explain that, we have a spectrum of risk that we follow, and our forecasting risk is in the form of a spectrum. And as that spectrum opens up, we realize there's increasingly higher levels of forecasting risk, and therefore the weightings, the level of concentration tends to reduce. That's
right. So I mean, we've got a bull and a bear case for all our stocks, so we can work out what our bull case for the portfolio is and a bear case. And obviously, the wider the fan of outcomes, the more difficult it is to build conviction on that. So in good times, when the economy is doing quite well, you tend to have a lot higher conviction with that. And vice versa, during bad times, risks increase and your required rate of return has to be higher to justify a higher weighting in equity.
So by default, we also had quite a high fixed income component in the fund domestically.
That's correct. So we had a high cash and fixed income, local fixed income component in the fund, which worked really well. The yields were extremely high, generating good real returns. Which we weren't seeing in the equity space. So it was a good decision.
So it's been a good 5-6 years in the fund, but we categorically say to clients, no manager domestically is returning the kind of returns we would like to generate just due to the terrible market conditions, but it's become a relative game. Are you outperforming your competitors? This fund's done really well in its competitive space, and not different to the income fund. We can show clearly that it's done it at relatively low levels of risk compared to competitors. All right, just moving on just briefly on the equity side. We've only been running a local equity fund, pure South African equity, for 2 odd years. We've been running another equity fund that consists of local and offshore equities much longer, and it's done very well. But just the local space, is there some upside now? The funds of all those equity funds have been really struggling, no matter who you are. There hardly anyone's in positive over the last year or two. What are we getting on our buy list in terms of potential returns for clients domestically? I mean, it is looking a lot better.
Yeah, so the opportunity set has certainly improved after the correction. There are certainly risks, and we often ask, what is the situation post-COVID, and do we see potentially a lag in pain in the system? And we do obviously evaluate that, and we see potential risks to it. But our buy list at the current levels are giving us between 20 and 25% expected upside. Do we expect this to be realized in the next 6 months or 1 year? We can't tell you, but we can tell you that our expected valuation level is 20% higher from current levels.
So stocks are effectively quite undervalued in South Africa. And if we could have a slight drift in the right direction from a macroeconomic perspective, there's potential for the South African market to do really well off a very, very low base. All right, then my last question to you is, if we take the managed fund, which is our bigger fund, do we think we've got what it takes to continue to deliver the kind of outperformance against our peer group that we've been able to deliver in the last few years? Do we have the ecosystem? Do we have the structures? And what does it take for us to continue doing this?
Yeah, I think, as you said, the skill set is there. If we take each bucket, of assets in the managed fund. Independently, each manager has shown skill in managing those assets. Offshore is done particularly well. Mark has done extremely well on the income side. So we've got all the skill sets in the fund to be able to generate returns. I think the point of difference between us and a lot of managers is that we know what we're looking for, and we've got a very repeatable investment process that is likely, in my opinion, to achieve it over time. And that is looking for assets that are high quality, that generate strong cash returns over time.
So I think I'll add to that, being involved in the fund myself and having managed this fund, this type of fund for 20 years in September. If you don't know how to do it over 20 years, rather don't do it at all. So, we've done it over 20 years. We understand market cycles. We understand valuations. We have a very strong framework around valuing offshore and local assets in the equity space, as well as in the fixed income space. People are highly focused here on doing their jobs. We don't have to try and cross-pollinate between each other. Marco knows, he runs his team on the domestic side, trying to understand what domestic assets are worth. And Mark does that in the fixed income space, and Rory and the offshore team does it in the offshore space. So we've outsourced the fund to the various components of our best parts of our business, and it's working really well. I feel that that structure is a very effective structure, and we cannot leave a discussion like this without making the point that we believe quality investing outperforms all other forms of investing. So if you buy high quality companies at the right price, and you've got the framework and homework to actually find those businesses, you're going to do better than buying junk. And that's the process we follow. We buy good businesses, strong balance sheets that generate a lot of cash flow with good management that aren't going to cheat shareholders. And that structure and staying with it gives us its own form of margin of safety. So it's a well-run product. Marco, I think you've done a brilliant job. And I don't see any reason why we can't continue it. But before you go, one of the clients has asked a question. So I'm just going to ask you while we're at it. He's particularly worried about the extent of government support systems, the amount of money that's gone into quantitative easing, the number of people that have lost jobs, and the extent to which the market has rallied. And there's kind of like a feel-good factor. And I think a lot of people are asking this question, is it actually sustainable? Or are the dark days still to come? Now, what is your feeling and our feeling on that, just in a nutshell?
Yeah, just maybe as a caveat, I'm not an economist. So if I look at what's been happening, we've had a massive correction. We're likely to have GDP contract by between 7 and 9% this year. And, how long is it going to take to recover that loss in growth? And I think most economists are looking between 1 and 2 years. But that's obviously not taking into account if there's a second wave of COVID or other structural issues or the lack of structural reform. So in a positive scenario, we can actually see it returning to normal over a couple of years. But realistically, it could potentially take longer. So the one thing that we try and do is maybe not expose ourselves to stocks that are in need of GDP growth to perform well. We're actually looking for stocks that, in spite of what's happening in the system, can actually perform well. So how long is the recovery going to take? Hard to tell. Most guys are projecting a V-shaped recovery, but it could be potentially turning into a U-type scenario.
And the question is a valid one, because it feels as if everything's come right in the markets overnight. I mean, we're hitting new, higher levels in some markets than pre-COVID, and the market's been very V. And I think the point has to be made that there's a restocking. So the market's looking at some of the economic indicators which have surged, and they've surged potentially due to the fact that there was destocking, there was a lack of stock in the system, and people would restock quite quickly after a period like this, after a zero growth period. They restock, and you get a surge in economic activity. And the point really is, does that have momentum? We'll be watching that very closely. I think Marco makes a fantastic point. We're buying businesses on 10, 15, 20-year perspective. And we're not buying businesses that need the economy to grow at a rapid rate in order for them to outperform. They kind of self-help businesses with a strong moat and good management. So that's the way we've dealt with this really difficult question that's actually impossible to answer at this point until we go further in through the cycle. Thanks, Marco, and appreciate your time.